time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
But we got a question from Bill via email on 23andMe wondering about the value of their genetic data. 23andMe, symbol ME or me on the NASDAQ, currently trades at about $205 a share with a market cap of $940 million. Founded in 2006, 23andMe is a consumer genetics and research company. The company has built the world's largest crowdsourced platform for genetic research. The company became public through a SPAC in 2021, where it's fallen about 80% since. First, let's look at the financials for Q3 2023. Revenue came in at $67 million, an increase of 18% year over year, but this is primarily due to their acquisition of the telehealth service company Lemonade. Not lemonade, not the drink, Ryan, before you start to try to drink a company.
Damn it.
The company still had an adjusted EBITDA deficit of $43 million compared to a deficit of $64 million the prior year. So less of a loss, but still a big loss. 23andMe continued a streak of net losses on a GAAP basis. For the quarter, the company had a net loss of $92 million compared to a net loss of $89 million in the prior year, so relatively flat on GAAP loss year over year. But on a more positive note, the company does have a massive cash position of $432 million. That's roughly 46% of the market cap. But they also had net cash used for operation of $120 million for the first 3 quarters, so 9 months of fiscal 2023. This also includes a one-time payment from GSK to extend its exclusive partnership with 23andMe for research, and that was $50 million. So if they didn't have that, obviously it would drop quite a bit, but they are working to earn that cash, but it's a big payment for them, and if they obviously didn't have that renewed or extended, then they would have had probably quite a bit more burn for the period. So with its current operations, value just isn't being created for investors. The company's management knows this, which is why they're looking to leverage its genetic database by integrating it with telehealth services. That's where they brought on their Lemonade acquisition. Effectively, they want their existing genetic testing to give customers a profile of disease that they are at risk of. Then they integrate those results with the telehealth and then pharmacy services. So they're trying to create that one next level. Go from one that you identify the issue or a potential issue, you go to this is an issue, and then they go to the treatment. So, but as of right now, they don't really seem to be creating any synergistic relationship as far as revenue growth right now. Like I said, the acquisition was just the add-on, or the revenue growth was just to the add-on of the existing revenue. And when asked about cost synergies in the last earnings call, management gave a non-answer of saying the two companies are complementary and their focus is on increasing value for the customer. So in reality, they're unlikely seeing cost synergies after that answer. However, they are involved in research leveraged by their data in help of the development of treatments for diseases, which it currently accounts for about 20% of the revenue as of last quarter. All the revenue in this segment comes from their GSK partnership, which started in 2018 and ends in July after their extension. That's where that $50 million came from. And this obviously, once this ends, their revenue from the segment could alter significantly for better or worse, but management isn't commenting on it right now, as they cannot, since the potential partnerships cannot be commented on until the exclusivity period, so investors are really in the dark for this. However, there is the blue sky opportunity for the company if the success of its treatment derived from its genetic database. The company currently has a notable treatment in development, an antibody treatment that targets CD200R1, a potential cancer treatment, and is currently in phase 2A of clinical trials. If successful, the company could be extremely lucrative, or the drug could be extremely lucrative for the company, but it still has significant and many hurdles to surpass, and it may never materialize. As well, they could potentially receive royalties from GSK 608, which they helped initially develop, but then they didn't want to keep on incurring operating costs. So they elected into an option of taking royalties, and they don't have to pay for the operating costs as it's developed by GSK, and that's currently in phase 1. The company's core asset is its data, and it could be at long-term risk. 23andMe uses genotyping for its analysis as it's cost-effective for consumers. That makes sense. They started in 2006. At the time, gene sequencing, which is superior as it does you can do the full human genetic information, was about $10 million a test. Yes, $10 million. And now that's down to about 500 depending on who you're looking at. So you're looking at exponentially lower cost to do this better test. And obviously, if you're looking at the research market, they might want these full genetic results. So it could potentially, if another company starts to build up a large enough database, it would have more depth than 23andMe. They have a wide spread. They have about 14 million users, but they do not have the depth of what modern gene sequencing could get. Overall, the company just does not fit our criteria. Simply, it's not near profitability. It's burning cash quarter over quarter at this time. Its current bullish thesis is about the same as any biopharma company of if the treatments can make it to market, if they can scale their treatments, it could really see a blue sky potential. But we're going to see many of those and many, many more fail than what do succeed. So, and then of course you have the risk of if their database starts to lose value, if other competitors come in, gene sequencing comes down, they're on an outdated to the point technology. It's just not something that's really creating value at this time, and there's a lot of risk. It's just not something we really invest in at this time.
Yeah, it's certainly interesting. Just, I mean, looking at that chart right now, how much the price has come down over time too. I mean, it's probably good that it's come down for sure. But yeah, I mean, the company just doesn't meet our criteria right now. I mean, I don't know if anybody has anything else to say.
It's interesting that they're like getting into like the royalty side of things or trying to develop drugs, using like built off of their data. It is interesting how they're trying to monetize that side of the business. Because that was
cash burn right now is really significant though. Over the first 9 months, it's gotta come down,
and it's
or else,
optionality.
At some point, they'll have to raise.
Yeah. Exactly, and who knows if any of those drugs will take off. So I mean, again, it's as much as people on the internet are going to be saying, Brett, you don't understand these drugs. You don't know, buddy. I know.
I don't know the product. I don't know the drug. I don't know the potential. Exactly. That's normally what we hear from these sorts of things. And of course they can. We're not saying that they can't have potential, but we're saying the risk outweighs the current potential reward. So down the line, let's say these drugs start to make it to market, we might consider them at that point if we see them being potential for investment, because we're looking at this from an investment point of view, not just a product point of view.
Yeah.
Right. And then as well, when you look at the financial analysis of a company like this, our perspective is that if the product or the service that they provide is a tangible product and service that is actually providing value in their particular industry, then they should be able to sell it and they should be able to generate revenue from that. And ideally profitability to the bottom line. If a company isn't generating revenue, nobody knows the commercial viability of that product or service. That's just a fact. Some of them may go on to generate revenue. Many, perhaps even most, will not. And so until the company is actually producing revenue, there's no point in pretending that you know a lot about the product or service, especially if it's something that's highly technical. Most of the people that feel that they have a good sense of the commercial viability of a product don't. It's an emotional attachment that they have. They want it to be viable, or something has been said, or they've learned something about it that encourages their thinking towards it being viable. But as much as we want to believe in something that could be revolutionary and create like huge profit in the portfolio, the first step is to actually see, do the experts in that particular industry believe that it's a worthwhile product to purchase? And if they do, then they have purchased it and the company has generated revenue. The company's pre-revenue, you just don't know.
Yeah. I mean, often you see investing, people buy the stock and then they get a massive confirmation bias. Every little piece of information that they see that confirms what they want for that company, they just, believe that blindly. And it's something that actually can lead to significant losses over the long term. That's what I have seen. And it can be something that you should avoid. That's why we always hear too, well, once it gets revenue, once it gets profitability, well, then you've already missed out. From what I some of the best stocks that we've ever recommended had profitability, earnings, revenue, and growth when we initially invested in them. And they had, I mentioned 4 of them today. All of them had 10x times growth after that. That's what everybody's looking for when they buy a blue sky type story. But you don't have to have the downside risk that some of these companies have.
Yeah, that's you got the proof really of concept for. With, with waiting a little bit, patient.